Good afternoon. This is Chris Brecher with Simpler Trading. April 11th free video. What's this about? This is all about reversion to the mean. And I'll explain that in a minute. But basically, the NASDAQ is way ahead of where the bond market is. All last year, when the bond market was getting tattooed, the NASDAQ got tattooed. So the NASDAQ, the bonds rallied, and the NASDAQ rallied. The bonds sold off at the beginning of the year, right here, and the NASDAQ corrected to the October lows. That's the October lows in the bonds. This time, the NASDAQ, which has a habit of overcorrecting, is all the way up to where it was in August, while the bond market hasn't broken up yet. So when the bond market sold off today, that is exactly why we played the reversion to the mean trade, and I'll show you what I mean. So, number one, this needs to rally before the CPI, during the CPI. If this invalidates this breakup, then I gotta think this is gonna go down like 300 points. It'll get under this peak. So the other thing to show you is this, which I'm pretty excited about. I've been doing this a long time. This was the video we had right here in the premium for our paid subscribers. Reversion to the mean tomorrow. I think rallies will be shorted at least in the last few hours. So what happened is this. So we were looking for the SPX to go down at the end of the day. As you see, it did. But it's sort of like baseball. So if a team is up 8-1 in the 8th inning, the probability of them winning the game, they have these probability stats now on ESPN and MLB.com. The probability of them winning might be 90%. So when this right here was all the way up here, that's when we bought puts. The probability of that working went up dramatically when this happened. When the Apple, the Lam Research, the Broadcom, the Meta, the Tesla, all of these big stocks that will pull the ES down, they started going down before the ES started going down. So here's 1521. I think you see that right there. 1521. So when did this start going down? 1451. Yep. Before 3 o'clock. That's when I jump on. And we did the puts right when I jumped on. So right about 3:15. So it worked fine. So the thing is, when these are all plummeting, the probability of this going down or this going down, reverting to unchanged before the CPI, goes up dramatically. So that's why the reversion of the trade, that was one of the reasons it worked. Traders don't want to be long overnight. They might not want to be short either, and that's why the ES was only up 325. Keep in mind, that's not a big deal. It was up 12, and then it went down 10 points. The SPX went from 41.20 to 41.08, but on the way down, we did fine. That's why you play it at the last minute. You can play cheap puts or cheap spreads. We played cheap spreads that work fine. Now the deal is, where do we go now? Well, the first thing is, if the bond market closed near its low, then it was also more likely that this would go down, not up. So I just want to keep that in mind. So this is the next thing I'm watching. Everybody's talking about the CPI tomorrow, and how it's so important. And I think it's important, no doubt about it. But I think this is more important. On the right is the bond market. And I'm going to show this now on a daily chart. There's the bond market on the daily chart. As you see, it had that rally we talked about right here. On the other hand, on the left is an inflation index. This is the Dow Jones Commodity Index that includes oil. Yep, look what happened there. So when the Dow Jones went down, the Dow Jones Commodity Index, starting in February, the bonds had a nice rally. Right here. Right there. So to me, the bonds and the stock market are very correlated. So the higher this goes, the more likely that the bonds on the right are not going to break up. Everybody thinks this is some kind of cup and handle, but they're less likely to break up if this commodities go up. So there you go again with probabilities. So what do I mean by probabilities? If this breaks up, the probability of that breaking up goes down dramatically. Now, this includes oil. So you might say, well, this is a DVC. This is the ETF commodity index that includes oil. So you might be, yeah, oil had a pop because of the OPEC. Big deal. That doesn't mean everything's going up. Well, this is the commodity index that doesn't include oil. This is the agricultural. Yep, that's a big move right there. Huge. So a point in that is very big. So you got to think the Fed is looking at this more than the CPI that's old. It's last month. It's stale. This is real time. That's another reason that we thought the bonds wouldn't rally, which they didn't. And that if the bonds didn't rally, then traders were more likely to watch the markets to just want to flatten before the close. Who on earth wants to be long when the bond market might break down and when the commodity indexes are going up regardless? So tomorrow, what do? I think tomorrow what we're doing is watching this bond market. If this bond market does sell off on the CPI, which I'm not sure it's going to, I still think that's more important over the next few weeks. But if it does sell off and gets back under here, now I know I showed it on TradingView, so now I'll show it here. That's the bonds there. This is the NASDAQ on the right. So if this bond market breaks under here, right there, then I got to think this NASDAQ is going to take back at least half that move. That's what we're going to be watching tomorrow. Have a great night. Talk to you later. Good afternoon, everyone. This is Chris Brecher, and I'm Senior Managing Director of Stocks at Simpler Trading. Thanks so much for watching this video. If you like our content, please leave us a like and a comment down below. Also, be sure to subscribe to our channel and click the bell notification icon so you never miss any of our great new content coming out. Good trading, and we'll see you at the next video. Take care.